Hey, what's up everybody? It's your boy Lewis and welcome back to the channel. Today we're diving deep into the world of investing in Kenya. Whether you're a seasoned investor or a complete beginner, this comprehensive guide is here to help you navigate the exciting investment landscape in Kenya. We'll be covering everything from the Nairobi Stock Exchange to real estate, breaking down complex concepts into easy-to-understand terms. I'm talking about the kind of information that can help you make smart financial decisions and build long-term wealth, the kind of stuff they don't teach you in school. So if you're ready to take control of your financial future and start building a brighter tomorrow, buckle up, smash that like button, and let's get started.
First up, we have the Nairobi Stock Exchange, or NSE for short. Think of it as the Kenyan version of Wall Street, where companies list their shares for the public to buy and sell. Now, when you buy shares in a company listed on the NSE, you're essentially becoming a part owner of that company. You're buying a small piece of their business. And as that business grows and becomes more profitable, the value of your shares can increase, allowing you to sell them for a profit. But hey, it's not all sunshine and rainbows. Just like any investment, the stock market comes with risks. Stock prices can go down as well, sometimes even lower than what you initially paid. That's why it's crucial to do your research, understand the companies you're investing in, and maybe even consider talking to a financial advisor. So how do you actually get started with the NSE? Well, you need to open a Central Securities Depository or CSD account through a licensed stockbroker. These brokers act as your intermediaries, executing buy and sell orders on your behalf. Once you have your CSD account set up, you can start buying and selling shares of companies listed on the NSE. Remember though, investing in the stock market is a long game. It's about patience, consistency, and making informed decisions based on your financial goals.
Next up, we have Treasury bills, or T-bills, which are basically like lending money to the government for a fixed period, typically 91, 182, or 364 days. Now, why would you want to lend money to the government? Well, because it's considered one of the safest investments you can make in Kenya. The government is very likely to pay you back with interest, making it a relatively low-risk investment. The interest rates on T-bills are determined through auctions held by the Central Bank of Kenya. So, the higher the demand for T-bills, the lower the interest rate you'll receive and vice versa. Investing in T-bills is a pretty straightforward process. You can do it directly through the Central Bank of Kenya or through commercial banks that act as agents for the central bank. T-bills are a great option for those looking for a safe and liquid investment for the short term. They're perfect for parking your emergency fund or saving for a short-term goal, like a down payment on a car.
Let's talk about fixed deposits, more commonly known as FDs. These are investment instruments offered by banks and other financial institutions where you deposit a sum of money for a fixed period at a predetermined interest rate. Think of it like this. You're giving your money to the bank for a set period, and in return, the bank pays you interest on your deposit. The longer the term of your FD, the higher the interest rate you'll typically earn. Now, the good thing about FDs is that they offer guaranteed returns. You know exactly how much interest you'll be earning and when you'll be getting your money back. This makes them a relatively low-risk investment option, especially compared to something like the stock market. To invest in an FD, you'll need to approach a bank or financial institution that offers them. You'll need to decide on the amount you want to invest, the term of the deposit, and the interest rate you're comfortable with. FDs are a great option for those who are risk-averse and looking for stable, predictable returns on their savings. They're ideal for preserving capital and achieving specific financial goals within a defined time frame.
Now, let's venture into the world of Eurobonds. These are bonds issued in a foreign currency, typically US dollars, by governments and corporations to raise capital from international investors. So, instead of borrowing money from their local markets, they tap into the global pool of investors, offering potentially better interest rates and diversification benefits. Now, you might be wondering why they're called Eurobonds when they often have nothing to do with Europe. Well, the name actually comes from the fact that these bonds were initially issued in European markets. Today, they're issued and traded globally. Investing in Eurobonds can provide exposure to different economies and currencies, which can be a good way to diversify your investment portfolio. However, it's important to note that Eurobonds can be subject to currency risk, as fluctuations in exchange rates can affect your returns. To invest in Eurobonds, you'll typically need to go through a broker or financial institution that specializes in international investments. They can guide you through the process and help you choose Eurobonds that align with your investment goals and risk tolerance.
Let's talk about money market funds. These are investment funds that invest in short-term debt securities such as treasury bills, commercial paper, and bankers' acceptances. Think of them as a pool of funds that invests in a variety of low-risk, highly liquid instruments. They're managed by professional fund managers who aim to generate stable returns while preserving capital. One of the main advantages of money market funds is their liquidity. You can typically withdraw your money at any time without incurring any penalties. This makes them a great option for your emergency fund or for short-term savings goals. Another advantage is that they offer diversification. By investing in a basket of securities, money market funds spread your risk, making them less volatile than investing in individual securities. You can invest in money market funds through asset management companies or through your bank. They're a convenient and relatively low-risk way to earn interest on your money while maintaining easy access to your funds. Let's dive into the world of cash value insurance. This type of insurance, often referred to as permanent life insurance, provides lifelong coverage and includes a savings component known as the cash value. Unlike term life insurance, which only provides coverage for a specific period, cash value insurance combines death benefits with a savings element, allowing you to accumulate wealth over time. Here's how it works. A portion of your premium payments goes towards funding the death benefit, while the remaining portion is allocated to the cash value account. This account grows tax-deferred, meaning you won't pay taxes on the earnings until you withdraw them. The cash value of your policy can be used for a variety of purposes, such as supplementing your retirement income, paying for your children's education, or even covering unexpected expenses. However, it's important to note that cash value insurance can be more complex and expensive than term life insurance. It's crucial to carefully consider your needs, financial situation, and long-term goals before deciding if it's the right option for you.
Let's explore the world of SACCOs, or Savings and Credit Cooperative Organizations. These are member-owned financial institutions that provide savings, credit, and other financial services to their members. Think of them as financial cooperatives where members pool their resources together to provide loans and other financial assistance to each other. SACCOs operate on the principle of cooperative finance, where members benefit from each other's savings and borrowing activities. One of the main advantages of SACCOs is their lower interest rates on loans compared to traditional banks. They also tend to have more flexible lending requirements, making them more accessible to individuals and small business owners who may not qualify for loans from banks. To join a SACCO, you typically need to become a member by paying a membership fee and purchasing shares. You'll then be eligible to save with the SACCO and access loans and other financial services. SACCOs play a vital role in promoting financial inclusion and empowering communities in Kenya. They provide a platform for individuals to save, access credit, and improve their financial well-being.
Let's talk about REITs, or Real Estate Investment Trusts. These are companies that own, operate, or finance income-generating real estate properties. They allow investors to invest in a diversified portfolio of real estate assets without having to buy, manage, or finance properties directly. Think of them as a way to invest in real estate without the hassle of being a landlord. REITs typically focus on specific types of properties, such as commercial real estate, residential properties, or healthcare facilities. One of the main advantages of REITs is their potential for regular income. REITs are required to distribute a significant portion of their rental income to shareholders in the form of dividends. This makes them an attractive option for investors seeking a steady stream of passive income. Another advantage is their liquidity compared to direct real estate investments. REIT shares are traded on stock exchanges, making it easier for investors to buy and sell their holdings. Investing in REITs can provide diversification, income potential, and the opportunity to participate in the real estate market without the headaches of direct ownership.
We've covered a lot of ground today, from the Nairobi Stock Exchange to REITs. Remember, investing is not a one-size-fits-all game. The best investment strategy for you will depend on your individual financial goals, risk tolerance, and time horizon. It's important to do your research, understand the risks and potential rewards of each investment option, and consider seeking advice from a qualified financial advisor. They can help you create a personalized investment plan that aligns with your specific circumstances. Investing is a journey, not a sprint. It's about making informed decisions, staying disciplined, and remaining patient over the long term. The key is to start early, be consistent, and stay focused on your goals. The opportunities for wealth creation in Kenya are abundant. With the right knowledge, strategy, and a bit of patience, you can achieve your financial dreams and secure a brighter future for yourself and your loved ones. So there you have it, your 2024 guide to investing in Kenya. Remember, the best time to start investing was yesterday. The second best time is today. So take what you've learned, do your own research, and start putting your money to work for you. Investing is a journey, and it's important to do your own research and consult with financial advisors. Don't be afraid to seek guidance, ask questions, and continue learning along the way. Thank you for watching, and happy investing in Kenya.